Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's about 30 minutes to go here until the closing bell and stocks higher. Let's welcome in Jared Blickery joining us to break down the headlines. Jared, what are you seeing in the markets?
Thank you, Josh. We are in bull mode, and we've got a lot of record highs to talk about here. Let's start with the Dow. That is up 500 points, or about 1%. And you're going to see on this intraday chart, we are right around the highs of the day right now. That is the kind of chart you want to see, lower left to the upper right. And also the NASDAQ is not at a high though, but nevertheless, it's up about 0.6%, a little bit less than the Dow, also close to its highs of the day. S&P 500 just notched its first intraday record high of the year earlier this afternoon, somewhere in there, 69.45. We do have 7,000 insights there. And also the S&P 500 equal weighted index. I believe that's good for a record as well. That's where every stock gets one vote. So that speaks as to the breadth of this rally. And finally, Russell 2000, not at a record, but nevertheless, some outperformance there, up over 1%. And I did want to mention this, the Dow Transports. We don't talk about those every single day, but the Dow Transports also at a record high of 1.6%. We'll take a look inside in a second, but very important. We see a lot of agreement among the companies that are making this stuff, that's the Dow Industrials, and those that are shipping this stuff, that's the transport. So that is Dow theory in a nutshell. Here's the bond market, 10-year T-note yield up a whopping 1 basis point to 4.18%. 30-year also up a basis point to 4.87%. Nothing particularly noteworthy about the levels or the speed there. So we're going to move on over to the sector action. Only energy and communication services in the red today. Energy down 2.5%. That is sizable, but that is almost matched to what materials is doing to the upside. That's up over 2%. Healthcare is in the number 2 slot. And then you have industrials, tech, real estate, consumer discretionary. But look at all that dark green up there. We have a broad base of not only a little bit of defensive, that would be healthcare, but also the cyclicals. And I'm going to dive right into the NASDAQ 100. What you're going to notice about the left side is not necessarily a lot of participation among the mega caps. You got some winners, some losers. Here's Tesla. That's down 4%. Nvidia, Apple, Alphabet just slightly in the red there. Amazon having its best day in months. That is up 3.4%. And then the chip stocks. We'll get to those in a second. But first, I wanted to note that with all the record highs we're seeing, we haven't seen one from the Mag 7 just yet. So they've been kind of sluggish to start the year. All of them off of their record highs by at least 4%. I think Alphabet is the closest there. I promised a dive into the semiconductor. Nvidia's a glaring exception, so is AMD, but check out Micron, that's up 9%. Western Digital up 17%. And if you look at software, now software doesn't always do the same thing as the chip stocks, but that is a pretty bullish picture as well. Not as dramatic as we see in the chip space, but nevertheless, a lot of outperformers there. I did want to point out China as well. They're a lot more red than green, but I want to get back to the two Dows. Here are the Dow Industrials, and you're going to see some nice outperformance, not only from some of the cyclical stocks that kind of grow with the economy, like Home Depot, for instance. United Health is a healthcare stock, a little bit defensive. Walmart is also defensive. That's in the consumer staples. Then you got IBM, Big Blue up 2%. So pretty broad swath looking good today. And then here are the transports. Uber having its best day in a while. That's up 5%. Not a lot of red here. UPS up almost 3%. FedEx a little bit less. And then the airlines doing pretty well as well. United up 2.8%. Delta up almost 1%. So you put it all together, the biggest of the big, not necessarily firing on all cylinders, but we do have Amazon up today and a lot of records to talk about, Josh.
All right. Thank you, Jared. Appreciate it. Well, CES is in full swing with Nvidia CEO Jensen Huang's keynote kicking off an eventful week. Big themes are already coming into focus, from how quickly AI is moving into consumer hardware to what tech leaders are saying about spending, innovation in the year ahead. Joining me now from the event in Las Vegas, we've got Yahoo Finance tech editor Dan Howley. Dan.
That's right, Josh. I'm actually here at NVIDIA's space at the Fontainebleau Hotel in Las Vegas. And right behind me are the company's new server racks. We have the Vera Rubin, as well as the prior generation, that's the Blackwell Ultra server rack. So, I mean, everything here that they announced is on display. And, NVIDIA kind of sucked all the air out of the room last year at CES, basically just dominating the conversation, seemingly doing it again here, although they do have some challenges. We also saw AMD's Lisa Su take the stage to keynote CES's first big day, she announced the company's latest Helios rack scale system. That's the first system that's meant to go head to head with Nvidia's big boys back here, the first from AMD. They also gave more details on the company's next generation GPU for data centers. That's that MI500 series. So a little more kind of razzle dazzle from AMD. We also saw Intel basically saying that they're about to launch their next generation Panther Lake chip. They call it the Core Ultra Series 3, which I got to see in person with some basic demos, things along those lines. I really do feel as though it's going to be a big deal for Intel when it launches, just because of the sheer capability that it has to offer. But we'll have to see how that really looks for PCs, and then what that means for sales going forward. It's all part of that turnaround effort. But a lot of larger themes here. AI, obviously, the discussion. We're here at Nvidia, AMD, AI, Intel, AI. Basically, everywhere you look, AI is just kind of plastered on everything. I'm not even going to lie. I saw a goofy little robot oven where you kind of scoop up ingredients and kind of drop them into little slots like a, I guess, toaster, and then it'll cook for you. It didn't look very appetizing. When it was done and finished, it looked kind of good. But at CES, there's going to be all sorts of weird stuff. I think that the main thing here, though, is those chips, those robots, and that AI.
Yeah, those robots, Dan, certainly a theme. I think I saw a couple on stage there with Jensen Huang, kind of actually stole the show, actually. I'm just wondering, what have we learned about that theme specifically, Dan?
Yeah, I think that when it comes to the robotics, it really is going to be something that companies continue to push forward. Now, it doesn't necessarily mean that it's here yet. Those little Star Wars guys are very cute. They hung out for a while during Jensen's keynote. There's a robot walking around here with a cowboy hat on. There's one that's doing kind of explaining how it would do surgery. There's a robot at Intel's booth where they basically say, hey, this company, it's for physical therapy, things along those lines. They were running NVIDIA's chips on board locally on that robot. Now they're running Intel. So Intel getting into that space. AMD showed off a new robot as well that's running on its own hardware. And you just see them kind of all over the place when it comes to CES. I think, again, this isn't something that's going to happen overnight. It's still something that is definitely in heavy industrial settings. We had Hyundai and Boston Dynamics talk about how they're going to be bringing the production scale Atlas robot into Hyundai facilities to perform different tasks and eventually scale that up. Hyundai talking about how they're going to have kind of a mass production scale of different robots in 2028. And so it's something that's coming, but I don't necessarily think that you'll be able to wake up and have Rosie the robot, doing chores around the house for you at this point. It's still very much an industrial level application. If I can get something to fold my laundry, God, I would take it right away.
Dan, appreciate all the great reporting, my friend, as always. Thank you. Some big tech names getting left behind in the market rally today, including Nvidia and AMD, is coming after the chip giants laid out their AI roadmaps at CES on Monday. So what does this tell us about the outlook for the AI trade? Joining me now, we've got David Stubbs, AlphaCore Wealth Advisory Chief Investment Strategist. David, great to see you. Let's start on that AI theme, David, because you seem to suggest here you think this AI boom can continue. Why do you say that, David? What gives you the confidence? Especially, David, as some well-known strategists have been telling their clients, I know, hey, they think some AI fatigue seems to be setting in here.
Well, great to be with you. I think it's AI evolution rather than fatigue. I think there's two kind of pathways to a further boom. One is the continued build out of the CapEx cycle. Look at the tightness that still exists in data center markets. Look at the tightness that still exists in energy markets. So AI direct CapEx and related CapEx, we still think is going to be a significant driver to the economy and markets really for the next 2 or 3 years. And then, of course, is the evolution point is the market rewarding firms which deploy AI and drive margins through it. And there's many, many firms that can do that in the next few years. And you see, for example, the strength of financials recently, and I think that's a sector where they have a lot of proprietary data and a lot of regular processes on the back end that can be automated. So there's all types of ways for the AI boom, I think, to evolve from here and continue to be the marquee driver of the economy and markets really for the rest of this decade.
And so let me ask you, Dave, if I'm a viewer and I'm following along on this AI evolution, how am I picking my spots here? How am I discerning winners and losers? I mean, is the way to do that, do I look for, David, the names that, okay, they control the whole stack, right? I look for like a Google. I mean, Sundar Pichai, he's got the chips and the cloud infrastructure and the distribution. Is that what I'm looking for?
That's certainly one way to go for sure. I think there's a number of ways to play it outside of buying, obviously, the marquee names in the chip space. Not to say that they won't do well. I think you could target any company with a low revenue per employee. That usually signals that they've got quite a significant number of employees, and potentially they can grow in the future without adding more. I think energy is a great way to play this. We have a shortage across the board. We have an evolving energy landscape across electric vehicles, across energy supply. And this is the important thing, is that in the S&P today, only 2.9% of the market cap is energy. So this is a theme where it's actually quite hard to play unless you really try. You could go to the high yield market, but only 11% of the high yield market roughly is related to energy. I think the best way to play energy right now is in the private markets. Look at private infrastructure funds which specialize in energy, or maybe a data center play. There's some large names, obviously, internationally as well, across Europe in the energy majors as well. So we like the energy theme because it takes a little work to get it. Right now, you don't need to work to play the tech theme. You could just buy the NASDAQ and you can buy the S&P. But the energy side of things, while it takes a little calibration, I think it's an area that we are very excited about.
You talk about investing overseas as well, David. You emphasize Europe and Japan. What has changed there, David? What makes them more compelling opportunities right now?
Well, I think the starting point for us is that international diversification is a linchpin to wealth preservation and growth in our view. We're fully aware that in liquid markets, you've seen an outperformance over the last 5, 10, 15 years from the United States. That has produced in liquid markets a valuation gap. Now, that gap can be explained by differences in sector composition and differences in return on equity. But I think if you're trying to generate income, if you're trying to play a theme like energy, if you're keen on what you're seeing out of the reform story in Japan and India, if you believe that certain structural weaknesses that have been present for a long time, the obvious one is European banks are no longer structural weaknesses. I think there are key themes you can play around the world in international markets. I think when you go to the next level, you can point into the private space and into the alternative space and focus on markets that in, say, private equity are less competitive than the US, private credit less developed than the US as well. And then in things like infrastructure, you can look around the world and see countries still building out the basics of infrastructure, a great complement to the digital infrastructure boom we see onshore here. So look, we still believe that US markets are going to perform well. They're going to be the core of wealth management portfolios in the United States. Of course they will. But I think people running a solely US portfolio should consider how high the dollar is, how attractive some of the themes internationally are, and work with their managers to get that exposure.
What's your advice, David, for fixed income investors?
Well, mainly to focus on relative value strategies. We are not seeking a huge amount of interest rate risk in this environment. Now, that's obviously an interesting thing to say with the Fed cutting 3 times already. Arguably, you're going to cut more this year, the market pricing in a couple of cuts. It's perfectly reasonable if the unemployment rate stabilizes. If it doesn't stabilize, we're going to get a lot more than 2 cuts. But lower rates at the front end do not necessarily mean lower rates at the long end, and we've seen a lot of stability there. What matters most, I think, for fixed income investors, especially in a multi-asset context, is what is the fixed income going to do if the equity market sells off? And no one knows the answer to that question. And because you don't know the answer to that question, unlike in the 2000s, 2010s, where it's quite clear you would get a rally, that's why it's harder to move into the interest rate risk. I think that all-in yields across both EM and across corporate fixed income are reasonably attractive for income investors. And I think that those people who despair of active management, whose S&P large cap active fund can't beat the index in fixed income, there is a lot of alpha to harvest. And I think that's also a good way to lean in and create a little bit of extra return there.
David, good to see you as always. Thank you, sir.
My pleasure.
Coming up, we're looking at the outlook for energy stocks amid the upheaval in Venezuela. That's next on Market Domination. Ford is cruising into the new year thanks to sales momentum in 2025. Yahoo Finance's Praz Submarinian joining us now with the very latest. Praz.
Yeah, nice quarter here and actually a pretty good year for Ford. Q4 sales up 2.7% versus a year ago. Full year up 6% to 2.2 million units, powered by truck and hybrid sales. You compare that with GM. They're up for the year, but down for Q4. EV sales taking a bite there for GM. But Ford's got hybrids, right? So hit a record in Q4 for the year with 228,000 hybrids sold for the year. The Maverick, a big winner. That pickup as a mid-size or a compact pickup. GM doesn't have the hybrids, right? So that's why they were suffering there. But I want to know, what other cars stood out?
Yeah,
Ford Bronco sales up 34%
it's
last year. I wonder, do I know something about a Bronco?
It's a great car. It's a great. I would say honestly, in my neighborhood, Praz, I'm telling you, Broncos everywhere.
The consumer speaking
everywhere. Yeah.
Ford said they're responding to consumer demand, right?
So to Josh Lipton demand. That's what they're responding to. Let me ask you, switching gears while we have you. EV space, BYD, Tesla. What's the latest?
Yeah, latest story is that BYD topped Tesla in a couple European territories. But look, this is just a continuation of what happened last year when BYD actually toppled Tesla for overall EV sales globally, pure EV sales, right? So there's not just in China, it's in Europe and even South America and places like that. So, look, I'm not surprised that Tesla, in particular in Europe, is suffering. You've had the Musk factor, you have the all kinds of new competition from VW to even BYD, right? To the Chinese brands that offer cheaper prices, almost better, if not the same, if not better features, right? And the stigma is sort of fading from these Chinese EV makers.
All right, fight to watch. Thank you, Praz. Appreciate it, buddy. Well, the U.S. ouster of Venezuela's president has raised questions about potential impact on global oil markets, but our next guest says the near-term fundamentals remain largely unchanged. Brian Kessens, Tortoise Capital Advisors, Senior Portfolio Manager and Managing Director, joining us now. Brian, it is great to see you. I do want to start on Venezuela because I'm interested to get your take there, Brian. Maybe start by framing it for us. How important, Brian, is Venezuela now to the global oil market? And what would it take to remake and rebuild it so it became a more meaningful, significant supplier in the years ahead?
Yeah, great question, and thanks for having me on today. And I think you characterized it well when you asked, what is it, how important are they now? Now they produce about 1 million barrels per day, which is significant, but when you look at the global market for oil, it's a little over 100 million barrels per day, so we're talking 1% of overall production. It's almost a rounding error as it relates to today. What gets people excited though is where they were 20 years ago when they were 3 million barrels per day and overall oil production was a lot less. They were a much more meaningful impact. And the sense maybe is that they can have that level of exposure on the global market again.
But for what I'm reading, Brian, we're talking about really a serious lift here in terms of rebuilding that oil market and oil infrastructure.
It is, and I think that we saw some of the market reaction yesterday to some oil stocks, and I don't know that it fully understands it's going to be $100 billion, at least 5 to 10 years before we really start to get material gains from a production perspective as it relates to Venezuela.
And when we talk about Venezuela, we talk about heavy crude, Brian, right? For maybe those who don't follow this market as closely, this industry, in simple terms, what do we mean by heavy crude and what are the economics there?
Yeah, so it is a heavier crude or almost a lower quality crude. It has more sulfur in it. It moves more like molasses as opposed to like a vinegar, like a light sweet crude moves. It's more similar to the Canadian oil sands than the crude that comes from the Permian Basin. And because it is heavier, it is harder to refine. And many, many years ago, the U.S. recognized this. Hey, we have an advantage, proximity advantage to both this Canadian and this Venezuelan crude. Let's build our refineries so that we can process this lower quality crude in a better way. And because it's lower quality, it's cheaper. It can be anywhere between 10, 20, at times even $30 per barrel cheaper than a light sweet crude like a WTI or Brent.
There's been a lot of hot talk about this particularly out of Washington. But do you see U.S. oil majors, Brian, moving back into Venezuela aggressively? What will it take to get them to move back in aggressively?
Yeah, I think for them to aggressively move back, I don't see them aggressively doing it. I think if they do it, they're going to be very deliberate in how they do it. First off, they're going to have to understand what the political environment is. They don't want to see any risk at all that their resource is once again nationalized potentially by Venezuela. So they want to understand first and foremost what are the rules of the game and how long can those rules of the game last. And then secondly, hey, how economic can it be for them? Today, oil is between $55 and $60 per barrel. Mm-hmm. The break-even costs for Venezuela are a little higher than that. So I think that we're going to need to see a move higher in the overall price, the market price for oil before they're going to.
And that price, so WTI, it was like at 57 last I checked. Yep. Where do you all see that kind of moving near to intermediate term?
Yeah, in 2026, mm-hmm. we think that a range for it, certainly where we're at now, but somewhere between $60 and $70 per barrel is where we see it ending the year. I think in the first part of the year, we're a little bit oversupplied to 300,000 barrels per day, maybe even a little bit more time. But once we hit the summer driving season and demand starts to pick up, it'll become clear again that I think we're going to add about 1 billion barrels per day or more of demand throughout the course of 2026. I think supply will be a little bit more restrained. And in the back half of the year, I think, though, supply and demand will be in much better balance.
So Venezuela, basically, we're saying important geopolitical event. You don't see it as a kind of a near-term market driver for now?
Not over the near term.
Okay.
Not at all.
Let's get to some places where you do see opportunity. Get to some picks, Brian. Williams Companies, ticker WMB. Why is that a buy here?
Yeah, we're big believers in natural gas and in natural gas infrastructure. If we look at natural gas from a demand perspective, in the U.S. alone, we're going to export more natural gas in the form of LNG next year. And in fact, we're probably going to add 10 to 15 BCF per day of LNG export between now and 2030. And then AI, we talked about it on your previous segment a lot, and the power needs for it. We think the majority of the power generation is actually going to come from natural gas. So that's another source of demand. Williams has arguably the most strategic pipeline in the U.S., going from the Gulf Coast up the Atlantic seaboard actually into New York City here. They can build a lot more laterals off of that. And they've taken an approach where they are comfortable supplying the data centers themselves, with not only the natural gas, but potentially with the power as well. I think there's a great opportunity in Williams.
Final pick, I want to squeeze this one in here too. Energy Transfer. Now that stock is down, it looks like nearly 20% over the past 12 months. You think that's an opportunity? Yeah,
we do. We think Energy Transfer from an asset footprint, it's unparalleled amongst anyone else, especially intrastate Texas. They too are in the natural gas infrastructure game. They are going to benefit from the data center build out too. They trade with a yield upper high single digits right now. They just came out actually this morning with forecast for 2026. Their guidance, it was above street expectations. We think that as they prove their story out, the cash flows come through, that they'll be rewarded.
Brian, appreciate your time in those picks. Thank you, sir.
Thank you. My pleasure.
We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.